bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 9th, 2025 episode. My guests this week are Charlie Rhuda. He's a partner in Novogradac's Boston office, and Julie Lawrence, a principal based in Tampa, Florida. Julie and Charlie are two of Novogradac's many experts on the low-income housing tax credit, which should give our audience an indication which direction this week's episode is headed. But first, you may be wondering why I'm wearing a Hawaiian shirt. Well, today is the day before this podcast is going to post. And the day this podcast posts, I'll be headed to Hawaii for our second annual Affordable Housing Conference in Honolulu. So hopefully some of you are listening to this. I'm going to see you there. Now, getting back to the podcast, the One Big Beautiful Bill Act, as nearly all of our listeners know, lowered the tax and bond finance test for housing tax credit properties from 50% to 25%. Now, with this lowering of the 50% test, states have the ability to nearly double the amount of bond finance tax credit transactions that they can fund with the same amount of bond cap. What does this mean in terms of units? Well, let's just look back at 2023. According to the NCSHA, in 2023, 8609s were issued for nearly 92,000 low-income units financed by private activity bonds, which means that the lowering of the finance by test creates theoretical capacity for over 90,000 more units of affordable rental housing a year. That is a lot of affordable rental housing. Now, I know that's a theoretical number. It assumes that states continue to allocate the same amount of bonds, just in essence half as much per project. It also implies that soft financing has to scale if they want to get the same ratio of new construction and the similar types of projects that they financed in the past. And I recognize that soft financing probably can't scale. It definitely can scale, but not at the same rate. But I will also note that it does create an opportunity for there to be more acquisition, rehabilitation, preservation developments. And there has been a shortage in many states of funds for AC rehab. So with all that said, we're seeing a lot more activity already in the private activity bond finance tax credit space, and we expect there to be even more. And I say there'll be even more because many more clients of ours who in the past have only developed 9% allocated tax credits, as well as market rate developers who haven't really participated in the tax credits, see this additional capacity for, over 90,000 units a year throughout the country. And they start thinking, well, maybe I should be being involved and use private activity bonds with tax credits to finance rental housing. Now, for those developers who have used the 9% allocated credit in the past, but not private activity bonds, they need to know that private activity bond rules layer on many additional requirements. There are some unique requirements just to private activity bonds, but there are also several requirements that are very similar to, but not exactly the same as the housing tax credit rules. And there's a lot of trepidation and warity if you assume that if it's uses the same verbiage, it's applied the same way. And that's the purpose of this episode. We want to take a deeper dive into the nuances and overlap of private activity bonds and the low-income housing tax credit. Now, the four overlapping areas we're going to discuss today are 1, the minimum set-aside test, 2, rent limit rules, 3, the treatment of over-income tenants, and 4, compliance and monitoring. Now, this episode is an expansion, probably not exactly an expansion. It's a additional discussion based on an article Julie wrote for the August edition of the Novogradac Journal of Tax Credits. I say it's not an expansion because I don't think we're going to cover everything that Julie wrote in the article, so you're definitely going to want to read it, but it is going to expand on parts of the article. And in that article, as you could guess, Julie compared the Section 42 tax credit rules with the Section 142 bond rules. I will also note, as a matter of history, back in 1986, when Section 42 was created, Section 142 did already exist. It was changed as part of the tax reform of 86, and conveniently, Section 42 was adopted. So we now have the Section 42 tax credit rules and the Section 142 residential rental housing bond rules. Obviously, these 4 points that we're going to discuss are not an exhaustive list. And as I mentioned, private activity bonds also have some of their own unique tests, but we're going to focus on the 4. And with that, Julie, Charlie, and I do have a lot we want to discuss within those 4 areas. So if you're ready, let's get started. Julie, Charlie, welcome to Tax Credit Tuesday.
Thanks.
Thanks, Mike.
I appreciate you coming back, Charlie. It's your 3rd appearance. And Julie, this is your inaugural appearance. So hopefully you'll come back soon. I would also note to our listeners, earlier this year, Charlie and I discussed what we referred to as sidecar financing or twinning of 9% credits and 4% credits. And that's an example where, you have a 4% bond transaction and it needs a little bit more subsidy to be financially feasible. And you end up layering in 9% credits as a way to make the development financially feasible. It's an indirect way of providing soft financing. We also have seen, though, twinning where the 9% transaction had an award, had some cost overruns, and there was excess basis, if you will, because they didn't have enough credits to award it to them to claim credits on the entire amount. And they carved out part of the project as a separate 4% bond deal that once again closed the financing gap. So I do encourage you to go back and look at the twinning 4s and 9s, that podcast that we had, because I do think you'll see that occurring more often given the lowering of the 50% test. But before we go into the 4 topics I want to cover with both of you, Julie, I'll let you go first and describe some of the services that you provide to Novogradac clients.
Sure. As Mike mentioned, I'm a principal here at Novogradac based in Tampa, Florida. And I focus primarily on LIHTC and HUD work, along with historic tax credits as well. I work with developers in many different states, but a significant part of my work is here in Florida, sunny Florida. And I love working with developers on everything from consulting on their initial applications and projections through final cost certification and 8609s, as well as their annual audit and tax work. I also have clients on the syndicator and investor side, and I'm able to see how these operating entities roll up into a fund, which is great because it gives me a different perspective in terms of evaluating these projects as investments and understanding the investors' needs as well.
Great. Thank you, Julie. And I'll also note Julie's at many of our conferences and certainly at our Florida conference every January. So you can meet her in person at one of our conferences and certainly in January in Florida. Charlie.
So similar to Julie, my practice is primarily focused on affordable housing, and the lion's share of it actually is working with tax-exempt bond transactions. We provide a lot of help up front when the transactions are being structured, right? Mike mentioned the sidecar 4s and 9s, and there's some other transaction structures that are getting, increasingly complex as everybody's trying to, spread their subsidies as wide as possible and develop as many units as possible that they can. And so we spend a lot of time up front on the transactions, getting them structured correctly, and then take them all the way through construction, cost cert, 15 years of stabilized operations, up to and including exit strategies.
Great. Thank you, Charlie. And I'll include both Charlie and Julie's contact information in the show notes so you can reach out to them directly. Now let's jump into the reason why you're joining on the podcast today. And that's to discuss the ways in which Section 42, which governs the low-income housing tax credit, interacts with Section 142D, which is what provides the tax exemption for private activity bonds that are funding residential rental housing. Section 42 obviously provides tax credits that generate equity to close financing gaps. And then Section 142 provides tax exemption so that the holders of bonds that finance residential rental housing, qualified residential rental housing, that the bonds financing them are the interest on them is tax exempt. As a consequence, the borrowers can have lower interest rates. And it's a combination of lower interest rates and the tax credit equity associated with the tax credits that make private activity bond finance tax credit transactions financially feasible, oftentimes along with some other sources. But Julie, maybe you could expand on the overview in terms of Section 142D and Section 42. And as I ask you this question, I'm thinking to myself, there are probably a lot of marketing folks out there that are saying, Mike, why do you keep talking about code sections so much? And it's because I can't help myself. Julie?
Sure. Okay. So I'd love to. So let's start with Section 142. So we're going to talk about subsection D in particular, which governs, like Mike said, the qualified residential rental projects financed with private activity bonds and really protects the tax exempt status of the bonds. So to qualify under Section 142D, a development must meet several key criteria. So the first one is that at least 95% of the net proceeds from the bond issue must be used to finance qualified residential rental projects. So moving on, I mentioned that Section 142D governs the qualified residential projects. So in order to be considered a qualified residential rental project, the development must consist of buildings or structures with 5 or more residential units, and the units must be rented to or available to the general public. Okay, so now we'll switch to Section 42, which governs the low-income housing tax credit program. So in the context of private activity bond finance developments, we're referring to the 4% low-income housing tax credit, which is a fixed 4% annual tax credit claimed over a 10-year period based on the development's qualified basis. So the 4% credit is also considered an as-of-right credit, meaning that if a project meets certain requirements, and most notably the finance buy test, it automatically qualifies for the 4% credit. So Mike talked a little bit about this in the intro, but the finance buy test refers to the 50% test, where at least 50% of the aggregate basis has to be financed with tax-exempt private activity bonds. And now with the new legislation, it's lowered to 25%. So that's good news. So I'll just add here too that private activity bonds and low-income housing tax credits can be used independently. A development can be financed with private activity bonds without claiming tax credits and vice versa. But however, pairing the two is a widely used strategy because it really brings a significant influx of equity into the capital stack, which makes these developments more financially feasible.
And that's so true because the equity is just such an important part. The additional equity from the tax credits is just such an important part of the capital stack when you're having affordable rent restrictions, right? Which effectively limit the revenue that you can generate. And so the equity provides a way to help get these financed.
Right. Thank you for that, Charlie. The only thing I would layer in, and that was a very good overview, Julie, thank you for that, is on the private activity bond side, the amount of bonds that a state can issue is limited. There's a volume limitation. So development has to be financed with private activity bonds that have been subject to that volume cap. So states are limited in terms of how much private activity bond financial transactions they can do. And there's uses beyond residential rental housing. Many states don't target predominantly their PABs to residential rental housing, but some states like California do. And since the 4% bond deals are limited based upon volume cap of bonds. The actual tax credits themselves don't come from the state's tax credit volume cap, because there's a separate volume cap for the tax credits themselves if they go through what are called 9% credits. And we often think of it as nines and fours. Fours, when you combine it with bonds, and nines when they're allocated. But technically, if you're doing if you're in acquisition rehab, where you're using 9% credits on rehabilitation, you technically get a lower credit percentage, 4% on the acquisition costs to a variety of other rules. So there's a bit of colloquialism between nines and fours, and I always want to sort of point that out. The other that I would note is when Julie referenced as of right, that the tax credits are as of right if you finance more than, or at least 50% now, or at least next year, at least 25% of your aggregate basis in land and building. You're not really automatically eligible, because you do have to go to the state and apply with state rules. So I don't think that it's different than their other credits, like investment tax credits for renewable energy, where if you meet all the rules, you just claim the tax credit. Here, you do have to go and apply with state rules. So it's essentially as of right, but not exactly the same as ITC and other tax credits if you work in those areas.
Mike, that's a great point, because in a lot of states, the agency that allocates the 9% credits and the agencies that issue bonds are different, but the underwriting has to be the same. And I, at least in the states I practice in, a lot of times I see the state allocating agency reviews the applications for the bond issuing agency to make sure they're in accordance with the state's qualified allocation plan.
One thing we say a lot in the affordable housing development is you have to follow the lowest common denominator. So you basically have to satisfy all the Section 42 rules and all the Section 142 rules. And if you have other financing, then you'll have other financing you have to satisfy as well. And everything you do has to meet all the different tests. And I will say, as part of Novogradac's efforts with a legislative tax working group and our other working groups with respect to other tax incentives, is to try and find more ways to consolidate those requirements so they're not different. I'd love if we could have an episode sometime in the future where we talk about how the Section 42 and 142 rules aren't different at all. Lead to more simplicity, more efficiency, and the rest. And it's certainly something I don't think we'll ever achieve, but we can aspire there and make more and more improvements. So now let's jump into the 4 areas that I mentioned in the introduction. And let's start with the minimum set-aside test. And the minimum set-aside test, there's a minimum set-aside test for tax credits, and there's a minimum set-aside for taxes and bonds. And as the name means, there's a minimum number of units that developers have to set aside for qualified tenants. However, the rules aren't exactly the same. I'll also note that the minimum set-aside test doesn't define how many tax credits you're able to claim. It just says you are eligible to claim tax credits. And the minimum set-aside test is a requirement for the bonds to be tax exempt. So Julie, what should our audience know about the minimum set-aside for the 2 code sections, Section 42 for housing credits and 142 for tax and bonds?
Well, the 2 codes are very similar in regards to the minimum set-aside test, but the average income test under Section 42 adds some complexity. So I'll start with Section 142D. So first we have the 2050 set-aside, which means that at least 20% of the units have to be rent restricted and occupied by tenants earning at or below 50% of area median income, or AMI. There's also the 4060 set-aside, which is at least 40% of the units have to be rent restricted and occupied by tenants earning at or below 60% of AMI. Okay, so now let's move on to Section 42, where we add in that complexity. So Section 42 allows for the traditional 2050 and 4060 set-asides, but you also have the average income test. So the average income test allows LIHTC properties to serve a broader range of incomes while still maintaining that affordability. So in order to qualify under the average income test, at least 40% of the units must be rent restricted and occupied by households whose incomes do not exceed the designated imputed income limit assigned to each unit by the owner. So the average of these designated income limits must not exceed 60% of AMI, with no units exceeding 80% of AMI. And I'll also mention here that the property owners must elect one of these 3 set-asides. And once that election is made, it is irrevocable.
I think once again, as Mike mentioned earlier, overlapping regulations mean you need to satisfy both, usually the most restrictive. So you can use the average income set aside in a bond deal, right? But you still have to make sure that you're satisfying the minimum set aside under Section 142 as well. In addition, there's some other similar requirements with a few key differences related to the minimum set aside. First is that the minimum set aside must be maintained on a development basis as a whole in accordance with 142D versus on a project basis. And when I say project basis, for those of you who've seen other episodes, on your Form 8609, line 8B allows you to designate different buildings into a project for a number of purposes, and one of those purposes is for meeting the minimum set aside. And additionally, Section 142D7, right? Because I'm also a person who likes my tax code sections, says that the applicable set aside must be continually satisfied throughout the development period, and that the development must certify that they continually meet this requirement each year. There's another Form 8703. It's filed annually at the IRS, separate from your tax return, and that form is generally due March 31st of each year once you've achieved once you've begun your project period.
So I'd probably just sort of summarize what both of you shared by saying that with lovely tax credits, you have to be both income and rent restricted for your minimum set aside test. For productivity bonds as a general matter, you have to be income restricted. And I'd emphasize, Charlie, your point about you can use the average income test for purposes of claiming tax credits and qualifying, but you still have to satisfy either the 2050 or 4060 test under the bond rules. And then I would just say, from the standpoint of leasing up, there's this ever expanding project concept for productivity bonds. You have to be satisfying your low-income occupancy requirements. Yes, low-income occupancy required, or at least income restricted requirements for bonds. Whereas for tax credits, you have to meet the minimum set-aside test by the end of the first year of the tax credit period. And I'll also note that in preparing for this, Charlie kind of appropriately pointed out that that's all kind of nice, Mike, all those sort of details, but as a practical matter, transactions are generally 80 or 90% more, or if not 100% low income, even on bond transactions. Because even if you want to do a mixed income bond transaction, you're generally going to carve it out and do a separate project that's 100% bonds as a way of states using more bond authority to support more affordable units. So some of these sort of rules might be interesting technically, but as a practical matter, most clients don't face. Did I sum up your observations well, Charlie?
Yes, you did.
So let's go past the minimum set-aside test. Let's go to rent limits. And Julie, if you could discuss, we've already kind of done more than foreshadowed the rent limits for Section 42 versus the rent limits for 142.
Sure. So rent limits under Section 42 for low-income units cannot exceed 30% of the income limit applicable to that unit's designation. So if a unit is designated at 50% AMI, its rent must not exceed 30% of that income limit, regardless of the actual income of the tenant. In addition to that, gross rents must be reduced by utility allowance paid by the tenants. So then we have section 142. So here there are no explicit rent limits. However, states may impose rent restriction based on income. So it's really important to read and understand your regulatory agreement. So also in addition here, there are no specific requirements to reduce gross rent by utility allowance paid by the tenants, which differs from section 42. So keep that in mind.
And one of the interesting things that I would add here is that section 142 can also be used for developments that are not using low-income housing tax credits. We're starting to see developments now financed with recycled bonds, which are still private activity bonds, but don't carry the as of right low-income housing tax credits. So, so again, section 42 and 142 are similar for financing deals with low-income housing tax credits, but then section 142 is a little bit more expansive because it also finances units that are outside of the low-income housing tax credit rule.
Great. Thank you for that, Charlie. I appreciate the additional commentary. Also, Julie, I appreciated you referencing the regulatory agreements, because you definitely need to be reviewing the regulatory agreements for both LIHTC and for the private activity bonds. And there can be calculation differences embedded in those. So it's very important that you don't assume any of the definitions are the same, even if they're used the same word or words, that oftentimes they'll have slightly different nuanced differences that you want to make sure that you're incorporating into your compliance plan. So let's now, Julie, turn to situations that we want to be common with respect to our tenants of affordable housing developments. We do want the tenants to be having ever rising incomes. And, as you've discussed, if they're going to qualify as a long-term tenant, there's certain income limits that they have to have incomes below those limits. But over time, their incomes are allowed to rise and they don't have to be evicted. However, rules kick in as tenants are over income. So Julie, if you could describe the rules, and it has to do with leasing new units, how the rules are different between looking at your development as a tax credit project and what you have to do with over income tenants under the tax credit rules versus looking at it as a bond finance development and how you have to handle over income tenants as a bond transaction.
Sure. Well, essentially under section 42, if a tenant's income rises above the allowable limit after the initial certification, so meaning it exceeds 140% of the unit's designated income level, you'll have to follow the next available unit rule, which states that the next available unit of comparable or smaller size must be rented to a qualified tenant, so that initial tenant remains qualified. So if the next available unit is not rented to a qualified tenant, the over income tenant becomes a non-qualified tenant. So basically, the next available unit rule helps ensure that a property remains eligible for tax credits even when a tenant's income increases beyond that allowable limit. So section 142D generally follows the same next available unit rule, but the next available unit rule is applied on a development-wide basis, not a building-by-building basis, unless it's also paired with the 4% credit, then it will align with section 42. So.
Right. That, Charlie?
I don't know. I was just going to say the interesting thing about the next available unit rule is if you have a 100% affordable low-income housing tax credit development, you should always be renting the next available unit to a qualified tenant. And so the next available unit rule is generally not going to come into play. Where it does come into play is where you've got mixed income, or maybe where you're less than 100% low income. And then it's important to watch that. And that can even be challenging for even the best and most experienced property management companies on mixed income development. So again, another example where you've got a rule that oftentimes we don't see come into play because there's other policy decisions that come into play that that make it, not come up as often as you think it might.
And when you mentioned the mixed income development, so when the rule kind of comes into play, it also reminds me of there's a deep rent skewing exception to the minimum set aside rules, which we're not going to go into here. But, just an example of, there's a number of sort of arcane rules that we don't have time to go into. And obviously in New York City, it's not an arcane rule, but as a general matter across the country, I would say it's an arcane rule. And I'd also just repeat what I said earlier, that, back in the day when there was lots of bond capacity and states weren't oversubscribed, and not all states are oversubscribed now, but more than 2/3 of the states are oversubscribed to the private activity bonds are used for residential housing. We're seeing less mixed income transactions. And if a project comes in, they want to be 80% market, 20% affordable, they'll actually carve out the 20% affordable and have that get a bonds just enough of that 20% piece and not get bonds for the 80% piece. And that's because the states want to take their bonds and finance more developments and bring more 4% credits to their state, which is kind of like a federal match. So let's move into their fourth area, which is compliance and monitoring. And, we could do a whole podcast on compliance and monitoring between section 142 and 42. Maybe we will one day. But for now, Julie, if you want to just give, a brief sense of some of the issues around compliance and monitoring tax credit deal, how that is different or overlaps with a bond transaction.
Sure. I'll kind of start with monitoring and talking about the oversight entities for each of these programs. So the oversight entities are really the state housing agencies and the bond issuers, and really could potentially be the IRS if there's any noncompliance. The state agencies administer both the private activity bond and LIHTC programs, so they have to ensure compliance with both programs. And the bond issuers ensure compliance with with federal tax law and for maintaining the tax-exempt status of the bonds. So the next thing I'll go over is the compliance period. So under section 142D, the compliance period is referred to as the qualified project period. So this is the time in which a residential rental project financed with tax-exempt bonds must meet the affordability requirements to maintain its status as a qualified residential rental project. And the qualified project period begins on the first day on which 10% of the residential units in the development are occupied, and ends on the latter of 3 different criteria. So the first is 15 years after the date on which 50% of the residential units are occupied. Second is the first day that no tax-exempt private activity bond issued for the project is outstanding, so really at bond maturity. And third is the date that any Section 8 assistance for the project terminates. And once the qualified project period begins, you're also required to file Form 8703, which certifies annually that the project continues to meet these program requirements. So under Section 42, the compliance period is the time period in which the property must meet program requirements to maintain eligibility for the tax credit, which is 15 years, beginning with the first year of the credit period for each building. And in addition to the 15-year compliance period, most LIHTC properties are subject to an extended use period of at least 15 more years, making the total affordability commitment 30 years or more. So there's also an annual reporting requirement related to the tax credits. You have Form 8609, which is issued by the state housing agencies to allocate the tax credits to the property and is filed only once. Well, Form 8609 is filed by the owner to report compliance with the low-income housing provisions and to calculate the tax credits for each year of the 15-year compliance period.
And I would just say that's actually Form 8609A. We were throwing a lot of forms around.
Or throw around code sections, might as well throw around forms.
Yeah, exactly. And I think this is just another example where you have overlapping requirements, and you always have to follow the most restrictive requirements. So you've got your 30 years for Section 42. You've got your bond project period for your tax-exempt bonds, and then you've got state and other financiers who may have longer periods of time. So again, you're always going to have to follow the most restrictive one.
And I would just note that when Julie mentioned the 15-year compliance period, she said generally they also have an additional 15-year extended use period. And that generally is because you didn't have to have that in the early years of the program.
Right.
Now it is a requirement for tax credit developments, and many states will go beyond that 15-year extended use period. California has a combined overall period of 55 years. And when I'm thinking about the qualified project period for private activity bonds, I always think of it as it's the later of when 50% of the units are qualified, or the bonds mature, because it's later of the two because Congress didn't want the bonds to be outstanding, getting tax exemption, but the project not being subject to the rules. So it's a later of those two. And they didn't want it to be pay off the bonds in 10 years. They wanted to at least get 15 years. So they wanted to get at least 15 years of qualified occupancy or longer, the bond subsidy is still available. And then they basically said, something, an issuer can make the date even longer. So I shared in that way just because it's easy for me to understand it and remember it when I think about it from what's the policy behind it. Because sometimes if I don't know the policy behind it, it's hard for me to remember what the rule is. So I would just add that. And then Charlie, maybe you could say something. We mentioned earlier that there are other tests, and Julie touched upon the 95.5. If you want to just make reference, we're not going to go into all the other bond-only tests, but if you could say a few words about the 95.5 test, because I know that's a service line that you often provide so that projects know they met the 95.5 test.
Yep. And I think we went into a deeper dive on this in one of the previous podcasts that I was on either in July 2024 or July 2023. But essentially, this is a test specifically for the bonds that says that 95% of the bonds have to be used on residential rental costs, right? And residential rental costs are defined a little bit differently in Section 142 than they are in Section 142, because there are things like, and again, without getting too far into the weeds, you can have a community service facility that's, if you're in a qualified census tract and satisfy a couple of other criteria, that would be eligible for low-income housing tax credits, but is not considered to be a residential rental cost under Section 142. And there are a few others. And again, this is not the right place to go into that. But essentially, it gets back to the same thing, that they want to make sure that the bonds are being utilized for the housing and they're not being utilized for fees or other types of expenses, which are legitimate expenses of a development, but they want to make sure that the bonds are really being put to the best use in building affordable units. And again, you can find out a lot more about that by one of the other podcasts. And I know I've done an annual webinar on tax-exempt bonds. I think Julie did a webinar this year on tax-exempt bonds. So lots of other opportunities to explore that more deeply.
So thank you both. I will provide a link to those prior podcasts on sidecar for 9 and 4 transactions, as well as the tax and bond specific calculations like the 95.5 test. I would encourage our audience, if you have additional questions about combining the loan for the tax credit with private activity bonds, to reach out to Julie and or Charlie. And of course, I'll have their contact information in today's show notes, as I mentioned earlier. Before I let you go, Julie and Charlie, do you have additional recommendations as to where our audience can turn to learn more?
So I always encourage people to reach out with questions. I regularly talk with developers who are new to affordable housing and help them to understand these regulatory and compliance requirements tied to both code sections. So I just think it's really important that they know what they're stepping into. And I also consult with experienced developers, reviewing forecasts and projections and guiding them through the 95.5 and 50% tests. So again, just reach out with questions or, if you need guidance on that. I'd also say that our conferences are a great way to connect with other people in our industry. So it's, I know Charlie mentioned having a great management company to help with some of these rules, but it's just really important to have a great team around you. And I think our conferences are a great way to make those connections and build on your existing relationships. So I'll be at the Nashville conference later this month, and I'll be, like Mike said, at the January conference in Fort Lauderdale. So I hope to see a lot of people there.
I just know we also have a conference in Vegas in December for those of you that are more West Coast focused. Charlie?
I would echo all of Julie's comments. And then I would also note that I believe each state has a state housing conference, which is another great opportunity to meet state folks and to hear more content related to development priorities, meet other developers, meet other professionals, architects, accountants, lawyers, and such. I'll give one example. Next week, I'll be up in upstate New York, in Rochester, New York, the New York State Association for Affordable Housing, where they're going to talk about housing in New York State, more particularly upstate. And I believe every state has one of those. So another great resource to not only get out and meet folks, but to hear directly from the agency folks about what they're really looking for and how you can help, best make the program great.
Then I'd also toss in the local ability tester working group.
Yes.
Dirk Wallace, a Novogradac partner, heads up. And that's a great way to meet with, fellow developers on a month-to-month basis and learn more about some of the sort of cutting issues in the local ability test credit world. And Julie was a little bit bashful about not mentioning her on-demand webinar from April. Now combining imagine this, productivity bonds and 4% tax credits.
Yes, and we go into the 95.5 test a lot in that one too. So
there you go. You get a double dose. You can listen to the podcast on the 95.5 and then go and watch the webinar.
Yep.
So thank you, Julie. Thank you, Charlie. Please stay around for the off mic section. But before we do that, as I say every week, please do subscribe to Tax Credit Tuesday on whatever platform you get your podcasts. And if there's a platform that you get podcasts from that we're not on yet, please email cpas@novogradac.com so we can get on that platform. If you're watching on YouTube, please take a moment to like or comment on the episode. And then I also like to note every week that I think it's great to share the podcast with colleagues. It's a great way for you and your colleagues to keep abreast of the ever-changing world of federal tax incentives. And I do know of firms where when someone starts, they'll have them binge listen or binge watch one of our, like a Real Energy Cash Flow Finance series, or so you want to be at LIHTC Developer Series and some of the others as a way of getting up to speed. And if nothing less, you'll learn a lot of the lingo by listening to the podcast, and so much of knowing a subject is knowing the lingo. With that, let's turn to the off mic section, which is always a great time for us to, for my guests, to be able to give a shout out to others working in the community development space. So Julie, who would you like to give a shout out to?
So I'd love to give a shout out to Celia Gunzaboli, who is the Vice President of Operations at Smith & Hensey. Smith & Hensey is a developer based here in Florida, and they do amazing work. Celia and I are actually both on the board of the Florida chapter of WAN, which is the Women's Affordable Housing Network. So I get to see her passion for this industry and her passion for teaching and educating others about the development process and just, about our industry in general. She just brings so much energy to everything she does. And I see how hard she works, and she's making a significant impact in our industry, and especially here in Florida. So way to go, Celia.
Great. Way to go, Celia. Keep up the good work. Charlie.
Well, in sticking with the tax-exempt bond theme of all this, I'd like to say Sharon Brown, who's a partner at the law firm Barclay Damon. I believe she's based in New York. She's been bond counsel on a lot of the transactions that I've worked on over many years. I've very much enjoyed working with her, great relationship over the years. My interactions with her have been primarily where she was issuers counsel, bond counsel. And so, again, part of a great team in order to make sure that that everything gets done and that housing gets built. And so, so thank you, Sharon, for all that you do for our industry.
Great. Thank you, Sharon. I echo Charlie's shout out as well. And I think I will give a shout out myself, which I don't usually do. But since we're talking about the lowering of the 50% test, I want to give a shout out to all those state allocating agencies and state finance agencies that are working to implement lowering of the 50% test as early as possible. Many are taking steps to, for either carry over private state bond allocation from this year to next year, or reduce the amount of allocations this year and use the 20% 5% or the 5% finance buy test next year for fresh bonds. And I won't go into all the details of that. And I think Rita Wyatt with California, with this California Debt Limit Advisory Committee, is doing a great job of, in essence, taking the lowering of the 50% test and expanding it in a way that is going to get, probably 18,000 more units financed of affordable housing in the state of California. So a shout out to Rita Wyatt and the work that she's doing. And my apologies for inartfully expressing how state agencies can take steps to, in essence, use more 2025 bond cap for affordable housing and a lowering of the 50% test. And with that, thank you, Julie and Charlie, for joining me on the podcast. And to our audience, I'm Michael Novogradac. Thanks for listening and/or thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.